We got BGs. They say, Jake, thank you for all that you do. How does Japan's 8-month of oil reserves affect the unwind? Does this buy them time not to raise interest rates? Well, that's a good question, and apparently so, because we saw, the reaction in the market, and then we've seen this big move back down, over 5,000 yen in a very short period of time. They're hanging out around 13,000 yen per barrel, a little bit over that. But again, like I said before, that's the level at which I thought they were going to have to start acting, because that's a pretty significant amount of inflation that's happened in their economy in a very short period of time. I mean, they were up, 20%, 25% in energy cost, and that's exactly what I thought would, cause them to have to move. So we'll see how long that takes to permeate their economy and actually cause the inflation. And again, things are a little bit slower moving, right? It's not an instant deal. There will be costs that continue to creep up. You've already started to see that here at the gas pump in the US, but it's not at the peak of what it's going to be, because the oil that's being pumped out of the ground now has to be shipped, has to go through, manufacturing, all of that stuff. And what's currently on the market will hit the market at higher prices when that happens. So that could be a couple weeks, it could be a month, it could be days. I don't know how long the Bank of Japan is going to hold out before they raise interest rates, but I do believe if the oil price continues to stay here and doesn't continue to drop, or starts to reverse and go higher again because conflict escalates in the Middle East, there you go. It wouldn't take much at all. So I'm continuing to watch that. With South Korea looking like they're going to invoke some monetary action, and China also down 5% in their stock market this morning, feels like Japan is probably next on the hit list there for countries in Southeast Asia that are going to have to take action when their markets go haywire. So we'll continue to watch. The charts that I'm watching are the 10-year yield in Japan. It's currently hanging out about 2.18, 2.2. As that spikes up closer to 3, that's when you're probably going to see the rotation out of U.S. Treasuries into Japanese Treasuries. Michael Guyad, another guy that I follow on Twitter that puts out great information, he's actually looking at the yield curve rising, and he was like, whoa, this is, he's got a whole fund and a whole bet that U.S. Treasuries is going to be the safe haven asset when all of this plays out. I'm concerned about that for him, to be honest with you, because I think there's going to be a huge rotation out of U.S. Treasuries into countries' own sovereign currency and their own treasuries. The JGB, or the bonds, issued by Japan. Why wouldn't you hold your own sovereign bonds if you could earn a good enough yield on it, right? So that's the risk, and that's why I think you're going to see, U.S. Treasuries in droves flow onto the market. There'll be huge amounts of selling pressure, and when that happens, you're going to see yield spike in, on the bond yield for us here in the U.S. Now that'll be quelled once we have stable coins. So I don't know if the last little issue here with the Clarity Act or the skinny, Clarity Act or whatever they're going to do is going to mitigate that risk. But once the banks start issuing stable coins at scale for intra bank settlement, that's what's going to drive the demand on the market for those U.S. Treasuries as they flow out from, foreign debt holders back home here domestically. And that'll stabilize the bond market. We'll be good. But that's what I'm watching for.